full. Oh, okay, so Administrative and Finance Committee meeting on Tuesday, September 13th. I'll call it to order. For the record, let's show that Pam and Wayne, Pam Giardini, Wayne Peterson of the committee are here. And
Mike Zizzi and Neil Glass with Leaf and Cole are also here.
okay, and Natalie Clark and Jeff Rose. Okay, so I guess the first thing on the agenda is the audit, and please do reading.
No, but I'll take a break, so I had to come up for air anyways.
Okay,
So a couple of things I wanted to discuss with you today. I normally have, certain required communications, so I'm going to talk a little bit about the audit opinion itself. There's a new format this year to the audit opinion. You may or may not recall that usually somewhere in my presentation, I always make a statement that we would return to the second page of the audit opinion before we tell you what you really wanted to hear, that both of the financial statements are fairly stated. So after all these years, they finally listened to me. And so they've now made the audit opinion right up front. So there's actually two paragraphs because of the multiple funds that you have. We describe what your statements consist of first, and then the second paragraph jumps into the fact that they're going to be fairly stated. Report still indicates that we follow generally accepted auditing standards. There are some new verbiage in there. It talks about us as the auditors being required to be independent and following ethical requirements. It still states that we had sufficient audit evidence. Still states that management is responsible for the financial statements and internal controls. A new statement in there that both management and auditor, this shows up in different paragraphs, where management and the auditor are required to consider whether or not the entity is a going concern, meaning are the doors still going to be on and the lights still going to be on a year from now. And so of course we had no issues with that. It discusses the audit objectives to obtain, and you probably remember I always say reasonable assurance, not absolute assurance, but reasonable assurance that your financial statements are free from material misstatement. So we're not saying that your financial statements are perfect. We've not done enough work to say that they're perfect, but we have done enough work to say that they are not materially misstated. This year, finally, after many years of delays, we were forced to implement GASB 87, which deals with leases. Under prior accounting, if you had a lease that used up most of the useful life of an asset, or most of the cost of it, you would have capitalized that. That was called capital lease. And then an operating lease would be something where you didn't. Typically, if you were renting a building or renting a piece of equipment, oftentimes those were operating leases. So they've changed the accounting a little bit on those. And so now we still have capital leases, but we now have financing leases. And so I think I told you before that when they came up with the GASB pronouncements that deal with retention, you OPEB, that I'm not a fan of those. They put a bunch of numbers on your financial statements that nobody understands. In my opinion, this one is equally as dumb. It violates virtually everything that we were ever taught as accountants when we started, which was don't gross up the balance sheet. So you don't just book assets and liabilities if it really has no effect. But that's exactly what this asset or what this pronouncement does. The objective was in really looking at it from the point of view of the lessee, which really isn't you, because most of the things that you have, you just go buy. So you do very little leasing. We do have a scrubber where we're the lessee, but we're at the last 6 months of that lease, and there's an exception in there. If your lease is less than 12 months, you're not required to follow this pronouncement, or that's what we did for the scrubber, because we would basically put that on and take it off. But as the lessor, you have these cell site leases, and what you're supposed to do is you're supposed to predict, what do we really think is going to happen with these leases? And I think that if we went to the leasing companies, their intention is, because we've got like 25, 30 year worth of extensions that are possible on these leases. And I think that their intent is that they're gonna exercise every one of them. I mean, particularly when we look at, what's happening with, any kind of rent expense currently at some point, and they're probably there now, they're gonna look at this and go, what a sweetheart deal we have. But because these leases go out, 25, 30 years, when you look at that stream of payments and you present value it, and you put all of them together, it's over $2 million. So we're literally putting a $2 million asset and a $2 million liability on your books, so that it corresponds to what the telephone company has to have on their books, which would be a corresponding liability. And that's really the crux of the issue. So that they're trying to make sure that if somebody's got a 30-year obligation, they want to get that on the books. So I think making the lessor pick up the same thing really seems kind of beside the point, but that's the requirement. The other thing that it does, because it becomes financing leases, it takes, you're looking at a stream of payments and you've got an estimated interest rate on this thing. So it takes what previously was lease income. So your lease income on all of your leases this year is somewhere around $80,000. It takes 60,000 of that and takes it out of lease income and puts it into interest income. So again, very difficult for me to argue and tell you how this makes a lot of sense, but it is the requirement, and so we're following it, and we'll have, so there'll be a new footnote in there related to all of that. In the current year, we did pay down our unfunded actuarial liability in excess of $3 million. But its effects won't really show up until next year. As you may recall, both your OPEB and your pension accounting, it takes the actuaries so long to put together the information that they need that we're always reporting a year behind. So your funding this year will show up as a deferred contribution, and it will show up as a reduction of the pension liability next year. It would not show up in expense, oddly. So your internal reporting considers that as an expense, and then we come in as the auditors and again make these adjustments that don't make a lot of sense. And take it out of expense, put it in deferred contribution, take it out of deferred contribution next year, and put it in a reduction in the liability. Because the calculation of both the pension and the OPEB expense is completely separate from the funding mechanism of it. So we calculate the expense, record a liability and an expense related to that. And so when you either pay it down or don't pay it down, its impacts go to the liability, not necessarily to the expense. Toward the end of the year, we transferred $5 million into LAIF, and we've got about, I think it was about, is it 2 million more in CDs that we had this year than we had last year? I know we had quite a bit more. And so oddly enough, what you're going to see there is you're going to see that your cash balances are significantly higher, but you're actually going to have a loss in your investment income in the current year. And again, it's kind of a timing thing that, we've got so much in CDs. As the interest rates go up, the market value of our CDs go down because they don't have a commensurate interest rate. But it's really kind of it's a paper loss, because it's going to turn around because we're going to hold these CDs to maturity. So we're never going to actually realize that loss. So there'll be, again, you've got an artificial loss happening now. You're going to have an artificial gain as they work their way back to maturity. And you make whatever the interest was on those that they promised you in the first place. So there really is no loss there. AR is up 20,000 this year. This is AR miscellaneous, not your billing AR. We booked an adjustment this year because our deposits that we collect, some of those, not all of them, but some of those were overdrawn. And so as the auditor, that's a concern to us. Again, it's only 20 grand at this point, but because we incurred expenses beyond the deposits that we took in, we run the risk that it could be a larger amount. So that's something that we suggest that we try to be more cognizant of as far as that goes. Significant fixed asset additions this year. the sports park improvements, fire building expansion, the boardroom enhancements that we're experiencing today, fire truck repairs, did a chip seal on the road to the treatment plant and installed several pumps. We did pay off our loan to the State Water Resources Control Board. That was $135,000 in principal there. We've made timely payments on our other debts, and we continue to pay down the interfund loan, which is now down to $844,000. As we talk about each year, we still have large balances in the will serve, but again, that's kind of beyond our control. But they are significant. That was pretty much what I had for you as far as my notes from the audit at this point. If you have any questions, comments, concerns, I'd be happy to address those.
Pam, do you have any questions or?
No, I thought that was a really great summary. Thank you very much.
Thank you very kindly.
And I failed to notice we don't have any public, so. Moving right along.
All right.
So these guys are gonna wrap up their field work today. And then when would you expect the draft report would be?
Normally, I would tell you that we would be turning this around pretty quick, but in all honesty, much like pretty much every other accounting firm in the area or in the country, we've been really hit hard by the Great Resignation. And so my team is stretched, to say the least. We will make every effort to get this turned around and get it to you in October. But I would rather underpromise and overperform than the other way around. So I think we're probably realistically looking at November. And again, it's 100% on us, but it just I've lost 3 seniors and have not been able to replace them. So I had Neil work 12 hours yesterday and that was limited. So that's my concern is that we're working everybody really hard, but at the same time, well, I just can't afford to lose anybody else because skilled accountants just don't exist at this point. I don't know where they've all gone. But from a personal note, I had one of the big national firms came in and hired a kid that had worked for me for 6 months. And they paid him a lot more money. And they made him a senior. 6 months experience. You're supposed to go assistant, staff, senior to 3rd year. He's at 6 months, they made him a senior. And it took me a while to figure out why they did that, because if they name him a senior, they can bill him at senior rates, and that's how they can afford to pay him the extra money. But but that's where the environment is. It's just been crazy. And so we continue to look for qualified staff, but it's been a real struggle. So for that reason, I think that October can be on.
Okay, well, we'll try to, what ends up happening is we'll get a draft of the financial statements, internally review it, finalize it with your team, and then it'll go on, then we'll prepare it for the presentation when you're available. So that sounds like it'll be like in November, at the earliest.
That's my expectation.
And then this year, now you've seen, you'll be able to participate remotely through Zoom, and you'll see what we see here.
I'll try and make sure I've got a view in the background of Pebble Beach or something, so you'll think I'm having fun. Anything else?
Unless you have questions, if you want to go over any of those, any of the items that you mentioned.
No, right. Very good. Thank
Yeah.
you.
I mean, the one thing I would tell you, and not that you asked, but and I'm sure I've told you this before, but you guys do a lot with very little. I mean, this is a complex between all the different funds you have, all the different things you do. I deal with a lot of places that call themselves community services districts, but they really do water and sewer. And so for you to do park and rec and fire and all that, and with the team that you've put together, they work hard and they do really good work. I mean, as I look at the adjustments that we made, most of the adjustments that we made are all adjustments that we would expect to make because they deal with, again, OPEB, pension, and this new lease pronouncement. They're kind of accounting wonky, if you will, and not as straightforward as, what I would call normal accrual accounting. Anytime you get an actuary involved, it's like, well, okay, good luck with it.
All thanks to our young lady over
Yes.
there.
And Neil does an awful lot of work before we get here. I mean, we're fortunate enough to get the opportunity to come up here. But we don't spend a lot of time because he's, between Natalie and Neil, they've done the lion's share of it before we get here. But a lot of effort goes into it, and they both should be commended as I off that. I used to say I'm just a pretty face, but as I get older, I'm not as pretty as I used to be.
Well, you're lucky. You could say it. I've never been able to say that. Okay, well, thank you.
Thank you very much.
Are we gonna continue here? Or?
Yeah, we're gonna stay here because we've got, and just one more item on the audit. This is the last year that we're under contract with Leaf and Cole. So, we'll be preparing to send out an RFP for these types of services for the next several years. But you may not see these two again.
And if not, it's been our pleasure.
Mike's gonna look for another client up here.
Yeah,
Like,
absolutely.
There's-
Okay. Stay here.
Yeah, they're gonna stay here and we just finished.
Oh, we're gonna bug them then.
I warned them.
Okay. Okay, so let's see, the next item on the agenda is review of strategic financial policies.
So, you have an objective of reviewing the strategic financial policies annually, and that's something that the board has delegated to the committee, at least over the last several years. You might recall that we created these financial policies several years ago. They cover a broad range of topics, and we've had just some minor tweaks to them over the years. We included the current copy in your packet, but they cover things like capital assets and depreciation fund. That creates our asset replacement fund. And I do want to discuss one item in this category because you may recall that earlier in the year, there was we did some modeling, financial modeling, when there was a proposal or a request to consider buying a new fire engine. And one of the issues that comes up with the fire fund is we've got a low asset replacement balance. And of course, just a number of constraints. And so making a big purchase triggers a requirement to invest more money in this asset replacement account. And this is all something that the board has total control over. There's no external requirement to do this, but you're essentially saving for its replacement. Looking at our current policy, vehicles are assigned a 5 to 10 year useful life, which means the depreciation on that asset, that fire engine, would take place using the current policy in no more than 10 years. It was suggested at the time that if we extended that, it might give, for fire engines specifically, it might give the board some more additional operational flexibility. And so a term of maybe for fire apparatus of up to 15 years might make some sense, because these engines are really designed to function. Maybe it's like first out engines for 10 or 15 years, and then maybe have an additional 5 or 10 year life as a reserve engine. Our current engine, our current Type 1 engine is now 20 years old and it's still in use. Although we've made some investment, a couple of significant investments in keeping it in usable condition. So I think it would be, if that's an item that there seemed to be some interest in that amongst the board. earlier in the year. And if the committee wants to discuss that, I think it would now be a great time. And if you ultimately decide that you'd like to add a new recommended life for, and I'll use the term fire apparatus specifically, it wouldn't affect other vehicles, the fire apparatus of a 10 to 15-year life to be added to this schedule, then that would provide guidance. If we bought another piece of fire apparatus, we could assign that kind of life, and it would extend the time that you have to save to fund its ultimate replacement. Just keep in mind that this isn't a magic bullet. It's not going to solve all of our problems. It just provides some more flexibility. One of the real challenges we have in the fire fund is just a fairly small, in a relative sense, asset replacement balance in that fund to begin with, and that's really the challenge, not how long we pay for it, but there was some interest in exploring this.
Karen, you?
Yeah, I have comments on that. So part of the reason I believe our asset replacement fund was low to begin with was because previous boards had decided not to fund it. And that's kind of what put us in our shape. And then recently, our fire chief got a new truck for himself. And in that meeting, I specifically remember him saying that we were asking questions, the board was asking questions on, why do you need a new truck, in a very quizzitive manner. I don't mean this any disparagingly, but I think if you look back on that tape, that he says, well, fire trucks will only last about 5 years. He didn't have a lot of mileage on that truck, and one of the directors, and I don't know which one, had stated they had the same kind of model of truck. I don't know if it's Toyota or Ford or whatever, and that it could go for a lot longer. So I feel like when we want to make money, we do one thing, and when we want to conserve money, we do another. And I'm not positive I'm getting a realistic viewpoint on how long these trucks, these fire apparatuses actually can run. And so, I'm afraid to change our policy because I think it's pretty good right now, and that we've had a problem in the past, and we should learn from that past board's experience about not funding that asset replacement correctly.
Let me try to address a couple of points. So yes, you're correct. There was a period of time following the 2008 recession when district-wide funds do not contribute to the asset replacement account. And therefore those were diminished. And in the fire fund, we've seen that maybe most impact us because we have a more pressing need. When I use the term fire apparatus, I was specifically talking about big equipment that pumps water and serves a broad purpose, not the fire chief's command vehicle. I guess that's something I guess we'd have to resolve, but I would think just that's a Chevy Tahoe or a GMC pickup would fall under the current vehicle listing. That would remain at 5 to 10 years. Even though we often get more than 10 years out of our equipment, this is supposed to be money kind of already in the bank. So when the time comes, it's available to be used. The fire apparatus is more, big equipment. Things like our type 1 fire engine, our type 3 fire engine, those are several $100,000, kind of items. So I think that's the difference that I would describe. That the fire apparatus would be big ticket items that have that are designed to last longer. And going back to the fire chief command vehicle, the problem that we have with that really isn't so much that it's aged out or, you know, has too many miles on it. It's, there's a funky transmission issue that has prevented it on occasion from being able to engage and drive. And we haven't been able to diagnose it. It's not something that, if this were not an emergency vehicle, it's probably not something that would have ever even gone to the shop for. We would have just, the person would have just stopped, because this happens just sporadically, you know. It's, I don't, it maybe only happens one out of every 100 times, and you've got to put it back into park and turn the key off and then restart it and put it back into drive. It's like a gearbox thing. If it was a vehicle that was used for parks maintenance or for utilities, it would be essentially a non-issue. It hasn't prevented the vehicle from being used, only for responding in a kind of swift manner. So I think that's why the chief's recommendation was to convert that vehicle from a primary response vehicle to a utility vehicle for the fire department to use for picking up supplies or going to the training facility, filling bottles, taking the crew to a training, that kind of thing. I don't know if I've clarified that or just made a mess of it, but that's a little background.
No, you clarified it. It just, you know, you're trying, my assumption off of that is that his command vehicle is less technically loaded down with equipment than the big fire trucks. And that the big fire trucks, as you stated, were designed to be, you know, last longer. My experience in life is the more gadgets on things, the more opportunity there is for it to go wrong. However, back to the issue at hand is what other ways do we have to increase this fund besides just extending the life of the vehicles, hypothetically assuming that our life extension is accurate?
So really extending that time period won't supercharge that fund. It really is kind of counterintuitive, because in many ways, getting more money into asset replacement is the long-term objective, right? If that fund is loaded, it gives you more flexibility about when you go to replace a piece of equipment. You'd have the money in the bank set aside to replace the equipment, and would provide you more opportunity to replace a piece of equipment that ultimately you may decide is necessary. However, because of the way our strategic financial policy is structured, the depreciation schedule creates kind of an automatic expense requirement out of the operating fund. So if you were to buy a fire engine for $1 million today and you would depreciate that over 10 years, it's going to say, okay, now I need a new $100,000 a year to go from the operational fund, the fire operations fund, to the asset replacement account. And again, this is totally, you have total control of this. There's no external requirement. It's just kind of a best practice to follow this type of scenario. So if we were to keep the 10-year life as we have before for fire apparatus, you know, $100,000 is, you know, kind of automatically gonna be programmed to move into that account, and so you don't have a lot of operational flexibility with it. If you give this a 15-year life, that's going to be reduced to like what, $75,000 a year. So you're gonna have some more flexibility with what you do with that $25,000. It's the same requirement. It's just going to last 15 years to push that money into the asset replacement account. So you have some more operational flexibility with that roughly $25,000 $25,000 a year for the first 10 years. Now, again, this year we decided, this current budget year, you recognize that this particularly in the fire fund, the asset replacement account is underfunded, and you took a discretionary action to push some of the savings that the fund created, or was anticipated to create into the asset replacement. So you over contributed, you contributed more than this policy requires. And you could still continue to do that even if you made this one little minor change, because it's you recognize that overall, even though we were contributing based on the schedule, there's a deficiency in that fund. And so we pushed some more money in there, recognizing that that fund is hurting. Now, it's hurting not just because we didn't contribute for several years, like 6 years, 5 years. That's certainly that's certainly a part of it. I would argue that it's a little more complicated than that. Part of the reason it's hurting, maybe a big part of the reason it's hurting, is the cost of fire equipment has skyrocketed. And so an engine that cost $250,000 20 years ago hasn't gone up at the rate of inflation. Or maybe it's gone up at the rate of inflation that we're experiencing today. That engine's now $1 million. So the cost increases have had a huge impact on our ability to utilize this program. Back when the district adopted this schedule, I think it was about 2015, when we developed the policies, there was some suggestion, and it was maybe fair criticism, that rather than using depreciation as the tool to develop this, that we would use a replacement cost factor, which would account for this increase in pricing and costs. Because if it's, I guess it's no different than you at home. If you bought a Volkswagen Jetta in 2010 and you go to replace it in 2020, if you save just what it cost you 2010, you would have been short. But because that was a valid point, a valid criticism. Our system was more simple, and having an asset replacement, a replacement cost methodology would have been more accurate, but it would have made things more complicated. We would have had to then determine what would the asset replacement or the replacement cost be, and at what point would you replace it. And it just, at the time, my recommendation was let's implement something, recognizing it's imperfect, it's got some weaknesses. That's better than what we had before, and there was always time to improve upon it, and there still is, and that'd be it's a fair criticism, but it complicates things kind of dramatically. The depreciation schedule is really simple. We book an asset, and if something gets purchased, we determine that it's a fixed asset, it's a truck. The purchase price is known because the system knows what we paid for it, because we wrote a check for the asset. It gets booked, it gets assigned to life. The system calculates straight line depreciation. That straight line depreciation turns into the asset, part of the asset replacement contribution amount. So it's pretty foolproof the way we have it set up right now. Just keep in mind that it's not especially in the fire fund, it sort of shows its ugly head because, again, combination of factors, not saving for some important years, costs going up much faster, the replacement costs going up much faster. This one minor tweak would not address either of those circumstances, but it does provide more flexibility. And I would argue, certainly, if you're going to consider spending $1 million on a fire engine, it better last 15 years. I mean, I wouldn't recommend something that was kind of on the edge. I mean, I wouldn't say it's a 15-year engine. Really, in our case, hopefully we get 20 or 25 years out of it between its primary use and its reserve use.
Thank you. That was incredible information off the top of your head, and I can appreciate that. But I think my question was, how else do we get money into the asset replacement fund? So we get money that goes into the fire fund from property taxes. We get money from the community facilities district, goes into the operating fund. How else can we increase that operating fund so that we would have more money to put into the asset replacement fund versus extending the life of the equipment. I'm really hesitant, I'm very hesitant to do that because of the problems we've had with our fire trucks and with the fund being low as is. And so, you know, again, my question is, how else can we generate more money into the operating fund versus looking at skewing the lifetime of a vehicle, which might, you know, bite us in the butt in the end, I guess is my perspective.
Yeah, so almost any of the sources of revenue into the fire fund could be used for this purpose. There'll be some sources not, like grants or something that are tied to a very specific purpose couldn't be used in there, but you're correct. Property taxes, you know, all the revenues into the fire fund could be moved, wouldn't be moved as revenues, but we could be transferred. Any of those revenues could be transferred into this asset replacement account. Just keep in mind that this is kind of a paper account. I mean, it really, you have total control of asset replacement funds, right? So it's sort of a paper set aside. I don't want to diminish it, but it's just so that you see and the public sees that we're setting this money aside. So really, if you save money in any of the other expenses aside from something like that's grant funded, those savings could be pushed into asset replacement, just as what's occurring this fiscal year. You know, that being said, the challenge overall is you have a forecasted growth in expenses and in the fire fund, as we know about, and some other deficiencies that maybe weren't part of the initial modeling that we now recognize, asset replacement being one of them. So anything that we do to increase revenues could, in theory, almost anything that we do to increase revenues to the fire fund could, in theory, benefit that asset replacement account.
Okay, Wayne, if I'm driving you crazy, you can step in and tell me. My point being is, okay, if I want to buy a $50,000 car, I work harder so that I make more money so I can put money into my fund to buy a new car. How do we get more money into the operating fund? Property taxes have gone up probably because we've had quite a few home sales here, and with the increase of revenue, or you know, with the market being so hot, that the new tax base is probably going up because prices in the houses have sold have gone up. So we'll be getting some more revenue in through property taxes. The other way of getting revenue in without hurting other funds is through community facilities district. That is generated by new growth. And so I understand that we're trying to get water meters relinquished so that they would be transferable for new growth. I'm assuming that then would increase our operating fund. Is that correct?
Yeah, I mean, it's a couple steps, right? Because right now the CFDs have its own revenue source and or its own fund. And thus far, those CFD funds haven't made their way out of the CFD fund into either fire or Parks and Rec, but they're available for you to do that. And so yes, if the growth of the CFD would create some flexibility for you to move that stuff to the fire fund. So yes, and in the long run, that would certainly happen, provided that any new parcels that receive these relinquished water units or any other water unit would be subject to the CFD. You know, there'll be some exceptions where that's not going to work, where that doesn't appear that we can expect, but for the most part, that's true.
Okay, so my feeling is that we might get growth out of these relinquishments that would bring in more money to the CFD fund that we could use to offset the asset management, asset depreciation fund. I forgot what it's called now, replacement fund. And I would rather personally wait to see what happens with those relinquishments and see if our money grows on that, than extend the timeline of the viability of a truck. And I would also like our board to brainstorm on ideas of how else you can increase that operating fund. And so that's my position now that we've run through my logic in your information. So Wayne, whatever you have to say to add to it.
Okay, I don't disagree with anything you said. I think though that what we're talking about here is a very minor change, which I personally would be in favor of. I think with the interest rates and inflation going the direction it's going, that we're gonna have some really serious discussions about how we generate more revenue, which was not scheduled to be part of what we're talking about today. But
Correct.
I think that definitely the board will be discussing that more than once in the near future. My feeling is that, again, I don't see this change, if we make it or don't make it, as an effect on anything really. Like Jeff said, it's a paper change. And I personally would be in favor of it. So I think we just take it back to the board. And again, we will be discussing ways to increase revenue more than once in the coming future, I'm afraid.
Okay, so then I guess the record should show that the finance committee had a split opinion on this, and then take it to the board to hear from our other colleagues.
Yeah, so that's certainly we can do that. Just keep it when I'm referencing this page 2 of the policy when it lists these various things. So, like for example, some of these items have a very broad, like collection facilities in wastewater have a 20 to 50 year life, and we basically then, when we make a purchase that's assigned to the collection system or wastewater facility, we administratively say, well, do we think that we're gonna have to replace that in 20 years? If so, we're gonna assign it a 20-year life. If we think this is gonna last a hell of a lot longer, and it's like, let's say it's a piece of pipe in the ground that's not very complicated, it doesn't have a lot of moving parts, it might have a 50-year life. So really, this isn't intended to be super scientific, although I absolutely, or super complicated. I absolutely would want to make sure that your depreciation schedule, based on why we use it and how we use it, is reasonable, and that you've saved up enough money to replace the asset before the expected life, before it expires. And that's the whole goal, right? Is to have the money in the bank to replace it, whether it's a piece of pipe in the ground or a fire engine or anything else. So we want to fully depreciate it before we expect to get rid of it, and need to replace it. So I certainly wouldn't want to I don't want to be so aggressive, or wouldn't want to be so aggressive that we say, hey, well, the fire engine might have a 25-year life. Why don't we assign it 25 years? That seems iffy, because that we don't have a great track record that everything they're all going to last that long. So it would be as simple as, again, adding a line that says fire apparatus, and maybe we'd even put like in parentheses something like large equipment only, to make it clearer, and then have something a longer. But we can absolutely let the record show that the committee discussed it, and does not have a consensus about whether that should be included or not, or added or not. In any event, there's other policies that are that was the one that I knew of that we wanted to discuss. There are other policies that are addressed in this document, cash reserves, although there's been no discussion in recent past about considering the change. We have a 25% reserve on all funds, and we've been able to meet that. And I have no reason to believe that that's inappropriate or we need to make a change. Debt reserve policies. We have a policy of keeping 1 year of debt service payment in reserve. And we have actually some external funding sources that require that very specifically, and so we book it for that reason. And it matches our policy. We've got issues on debt issuance. That is not something that's come up frequently in the district, although this provides us some guidance. We have policies on capital fees, policies on budgetary controls. OPEB, this is one that we've made a lot of progress on over the years in following this, and then actually just sort of supercharging it as money's become available, and really improved our position relative to what was expected at the time. Building rentals and deposits, components of what's in the fund balances, purchasing policy, which is a separate document and was only recently adopted just this past spring. The financial reports, items that are distributed from the finance officer that lists those, including your monthly treasurer's report, etc. Those are the components of this policy. So this review today can include a discussion on any of these areas, and if the committee does believe a revision is warranted, it would be appropriate for the committee to make such a recommendation to the board. And then this document was approved by resolution, as I recall, so would require formal action by the board to make a revision to it.
Any questions, Pam, or?
No, I'm actually good with everything else.
Yeah, this is fairly complete, I think, so I don't have anything that I would recommend a change at this point.
Okay, yeah, good deal. Well, then, I mean, is there, since there wasn't, I guess we can go one of two ways, since there wasn't consensus about amending it for the purpose of this larger fire apparatus, is your expectation that this would that would still go forward? It just wouldn't be accompanied with a recommendation from the consensus of the committee, and it'd be left up to the board to determine?
No, that would be my concern,
I agree with that.
Okay,
because then you could just go ahead and
it can still go forward.
go forward.
Yeah, again, okay. All right, then we'll get that calendared at a future board meeting. Again, there's not urgency involved here.
Okay. So that's it.
Those are the only items we had on this agenda.
Natalie, you have anything you want?
I'm all good.
Okay,
Before we leave, I just want to thank Natalie and Jeff for the financial statements information. Every year we come through shining, and I know that falls on your shoulders a lot, and I appreciate all the work that you do and that we always get really clean audits. That is not my forte, and so my hat's off to you guys.
Well, Natalie and her team deserve all the credit. We are fortunate to have a stable group, and Natalie deserves any accolades that go her way. I know it's her favorite time of year.
Good job, Natalie. Good job.
Thank you, thank you.
she looks forward to it. She said the auditor is coming. Yay! I would, yeah, I think we ought to, and I agree with everything Pam said, and I would like to see that included in the minutes. So. All right, so I will adjourn the meeting, and thank you all. This really was a lot faster than I had anticipated.
Okay, thanks, everybody.
Thank you.
Hi, Pam.
Bye, Pamela.
Bye.